First, financial forecasting, covered in Section 10 in the e-text. At the beginning of each year, typically firms have a business planning process. The first step of that process is a sales forecast, that is to forecast both the physical units of the product to be sold and the cash generated by those sales. That forecast is distributed to two sides of the firm. Over on the left, we have production planning side. These this forecast is used by those individuals in order to ensure they have adequate resources, that is, raw materials, labor, factory space, and so forth, adequate resources to produce the products that are projected to be sold. The sales forecast on the right is used to ensure that there's adequate cash financing for the operations of the firm. On the finance side, there are two concepts that are being used to evaluate the process. First is we have something called the SGR, or Sustainable Growth Rate, and that is the growth rate of sales that can be supported purely by internal cash flow. If you recall, that's something called cash flow operations. Cash flow operations was the cash flow generated by the daily production sale of the products. So that's a sustainable growth rate. Now, a second concept is differential funding needed, and that's the case in which the sales forecast is such that the firm will need external financing. That is, they need to go out and sell stocks and bonds to finance the operations of the firm. And that is being contained in this concept called cash flow financing, or CFF, that is cash raised through the sale of stocks and bonds. So first, let's look at sustainable growth rate, or SGR. The formula in the sidebar is SGR is equal to ROE, that is return on equity, multiplied by 1 minus payout ratio. Also on the sidebar are the formulas for ROE and payout. ROE is the ratio of net income to equity, and payout ratio is equal to dividends divided by net income. So let's look at a typical problem. If a firm has $10 million in net income, $50 million of equity, and pays $3 million in dividends, what is its SGR? So in this case, we're going to have to solve for ROE and payout ratio. So the ROE is be the 10 million of net income divided by the 50 million of equity. So it's ROE of 20%. The payout ratio, the 3 million in dividends divided by the 10 million of net income. So there's a 30% payout ratio. 30% of income is paid out in dividends. Plugging those two into the first formula, we see that our sustainable growth rate is 14%. In other words, if the company is projecting that sales will be 14%, then internal cash flow can support that level of sales. Now, what if sales projected to grow much faster than SGR? Then the firm needs to project the need for additional funding, the need to issue stocks and bonds. The formula for DFN, first of all, the formula in the sidebar is equal to DFN is equal to assets minus the sum of liabilities and equity. Now, you might encounter the wording of this slightly different on the question and the OA. It could be assets minus liability minus equity. They both mean the same thing. It's just a matter of whether you have the parentheses in the equation or not. They mean the same thing. But the first one is what's on the sidebar. Now, when we start talking about assets and liability and equity, we're going to be using what's called the pro forma balance sheet. Now, the official balance sheet is always looking back to the prior year. If we looked at the balance sheet, the real audited financial balance sheet, that would be the status of the company as of the end of the year last year. The pro forma balance sheet is the balance sheet that you project it will be based on the sales forecast. That is, given that sales will increase, you would project that some items on the balance sheet would be larger. Now, there are two different types of accounts that are part of this pro forma balance sheet. First, we have spontaneous accounts. Those are accounts whose dollar values increase and decrease with sales. So what we were talking about is current assets and current liabilities. Remember, before we referred to these as operating assets and operating liabilities because their balances tend to increase and decrease with the level of production and sales. Next, we have discretionary assets, and those are the ones changed only by management decision, such as purchasing equipment or issuing bonds. Typical example, a firm forecast sales to be 200 million, current assets to be 25% of sales, and plant and equipment to be 25 million. Its sources of funds include bonds of 30 million and equity of 25 million. What is its DFN? So first thing we need to do is project assets. So first thing, let's project our spontaneous assets. We have sales of 200 million and current assets projected to be 25% of sales. So multiplying 25% times 200, we're going to have 50 million of spontaneous assets. We then add the 25 million plant and equipment. So our total assets are projected to be 75 million. Then for liability and equity, we're given bonds of 30, equity of 25, their sum 55. So DFN, assets minus the sum of liabilities and equity, or 75 minus 55, gives us a DFN of 20. That means that the firm would need to issue $20 million of external financing, that is, sell stocks and bonds to raise $20 million. Now, an easy way to think of the DFN is that the balance sheet must balance. Whatever the dollar amount is on the asset side of the balance sheet, you need the same dollar amount on the right-hand side. Next, let's talk about capital budgeting. Now, capital budgeting is not a very descriptive term. Really, we're talking about the evaluation in the potential acquisition of long-term assets. Now, this particular area is based on time value of money. As we mentioned earlier in the first session, the reason we study time value of money is it's the basis for the valuation of bonds, the valuation of stock, and now the valuation of potential capital investment projects. Now, there are three cash flows that we need to project. First step in any capital budgeting process, let's project the cash flows. First, we have something called the initial cash outflow. That's just simply the upfront cost to buy and install the equipment. Let's just say we're going to buy some robots in order to automate the production line. So what does it cost to buy it, have the equipment shipped to the factory and installed? Second, we have something called differential cash flows, and that is because of the purchase of these robots, how much additional cash flow is generated, how much additional profits are generated by the fact that we invested in these robots. And then finally, we have terminal cash flow, and that is at the end of the investment project, whether it's 10 or 20 years down the road, what are potential cash flows down the road? So let's look first, initial cash outflow. The sidebar formula is the cost of asset plus shipping and installation expenses plus the increase in net working capital. Now, the first two items are pretty straightforward. Cost of the asset, that's just what it costs to buy the robots. Shipping and installation expenses, what does it cost? Cash out of pocket to ship the robots to the factory and get them set up and installed, ready to produce products. The third one perhaps is not quite as clear cut, the increase in net working capital. Well, now remember we said that current assets and current liabilities, sometimes called operating assets and operating liabilities, tend to increase and decrease with the level of production and sales. So if we're going to invest in some project that's going to expand our production, current assets and current liabilities would probably increase. They're spontaneous accounts, as we described earlier. Remember, net working capital is current assets minus current liabilities. So if there's an increase in net working capital, that means current assets increase more than current liabilities. If you recall, increases in assets are cash outflow, increases in liability is cash inflow. So any increase in net working capital is cash outflow. So let's look at a typical example. Equipment purchase price $400,000, shipping installation $50,000, net working capital increase $100,000. So pretty straightforward calculation. Add up to three, and we got $550,000, and that's a cash outflow. Now note the initial cash flow is always a negative. It's always the money you're having to pay to buy those assets, to buy those robots. Now, a similar question that's a little bit different is, once we purchase that equipment, what is the accounting entry to gross plant and equipment? Now, as defined by GAAP, generally accepted accounting principles, the number that we put in gross plant and equipment is the cost of the asset plus shipping and installation expense. It does not include increase in net working capital. That's just defined by GAAP. Now, why? What's the logic behind that? Well, think about it. Where's net working capital? It's up there in the top half of the balance sheet, the part highlighted in blue. Where's gross plant and equipment? The lower left quadrant, highlighted in salmon color, long-term assets. Well, you just simply don't take a number from up there in the blue part of the balance sheet and move it down to the salmon color part. It stays up there in the blue part. So that's why you don't include that in the gross plant and equipment. Second cash flows are the differential cash flows. And the sidebar formula is net income plus depreciation expense. So we're talking about the additional cash flow generated because we invest in the project. Now recall, when you're calculating net income, that one of the deductions is the depreciation expense. And depreciation, of course, is a non-cash item. That is, there's no cash movement in or out of the firm because of a depreciation expense. It's just an accounting number. So to get cash flows, cash inflows, we needed to add depreciation to net income. Now, you could be given a really simple example or problem on the OA, such as you're given net income, given depreciation, what's differential cash flows, but they'll probably make it a little bit more difficult. So let's look at what might be a typical problem. Revenue is $200,000, operating expenses is $50,000, depreciation $25,000, tax rate's 20%. So let's first, we want to calculate net income. So we're going to have revenue of $200,000, subtract our two expenses, operating expenses of $50,000, depreciation $25,000, and we get earnings before taxes. Then we need to deduct taxes to get net income. Well, you can either multiply by 1 minus the tax rate. That's a proportion of earnings before taxes the firm gets to keep. They get net income of $100,000. Of course, the other way is you can multiply the earnings before taxes by 20% in order to get the dollar amount of taxes, and then subtract that from earnings before taxes to get net income. Either way, you end up with net income of $100,000. Then to get DCF, we need to take net income add in that non-cash item depreciation, and so we get 125,000 per year. And this is for differential cash flows. It's not a one-time cash flow. It's year after year after year for the life of the project. So if the project lasts 20 years, it's 20 years of 125,000 per year. The final cash flow is terminal cash flow. That is at the end of the project, when the robots are no longer useful for the firm, we're going to cancel the project, and there may be some cash inflows and outflows that occur. So the formula on the sidebar is the terminal cash flows are equal to the salvage value minus taxes paid plus net working capital recapture. First of all, salvage value. Salvage value, that's just simply what did you sell the old equipment for? You go out, it could be that they're really totally worn out, you get zero for it. But quite often, somebody might have some use for those robots, and so you can sell it for some positive price. So that's cash in the door. Net working capital recapture. Let's look at that item next. Now remember, in the initial cash flow, we had some increase in net working capital. A higher level of production sales, we needed more current assets and current liabilities to support that higher level. Well, when we no longer are producing those additional products, then we no longer need those current assets and current liabilities. This is referred to as a net working capital recapture. So while in the initial cash flow, the increase in net working capital was a cash outflow, here it's going to be a cash inflow. We're going to recapture it. We're going to reduce those current assets and current liabilities. So those first two items, we don't even need to use calculator. They're just given in this example. So about the only thing we need to do is calculate taxes paid. So how do we do that? Taxes paid would be equal to the sales price, the 100,000, minus the book value of 20,000. So there's an $80,000 profit. And anytime there's profit, the government taxes it. They're going to tax it at 40%. So we're going to multiply the 80,000 by 40%. We find out that the corporation is paying $32,000 in taxes. That's a cash outflow, of course. So what is terminal cash flow? It's a $100,000 salvage value minus the $32,000 of taxes paid plus the $100,000 net working capital recapture gives us terminal cash flow of $168,000. Now notice if the sales price had been less than the book value, then there'd be a loss and the corporation would get a tax refund, and that would have been a cash inflow. Now, just one item of terminology, book value. If you look at the balance sheet, you don't see the term book value. It's really just another term for the net plant and equipment. That's what you'd see on the balance sheet.